Hi everyone, so today I'm going to go into a lot of detail about a company I've been studying for a while now, called Redbubble. It was brought to my attention by Ben Wales here on YouTube, so thanks Ben for bringing this to my attention. I'll break it down in detail, and by the end of the video, I'll attempt to find a good buy price for us. Now, before we get started, you will need a brokerage account that can allow you to trade Redbubble, which is actually on the Australian Stock Exchange. There is a secondary listing on the OTC markets in the US, but the volume is actually really low. It might be hard buying compared to on the Australian Stock Exchange. And for those who want the safest brokerage account for buying shares in many different countries like Australia, I have a link to Interactive Brokers in my description where you will get free Interactive Brokers stock for signing up and using the platform. Now, if you think brokerage companies are all safe and they're all the same, well, you are wrong. I have friends and family who have been victims of bankrupt brokerage companies before. They are not all created equal. Interactive Brokers are, in my opinion, the safest and one of the best. They are far better than Robinhood or Webull or anything else like that because Interactive Brokers have decades of experience, a strong balance sheet, and they're a trusted business. I think it's unwise to risk all your money in a startup like Robinhood or Webull or those apps. I think it could be problematic and you just don't need that extra risk when you're investing. Interactive Brokers also serve people in most countries throughout the world. So if you're in Germany or Japan, Australia or Georgia, you can get an account. I personally have an account with them. And like I said before, the link is in the description to sign up and you'll get that free Interactive Brokers stock as a sign up bonus. Okay, now let's get into the deep dive into the company Redbubble. Redbubble is about $1 billion Australian company that is a little like Etsy, but with a few key differences. Like Etsy, it has a two-sided marketplace with buyers and sellers. These network effect type businesses are easy to start, but they're really hard to grow. You need to attract both buyers and sellers at the same time somehow. But once you have the buyers and the sellers, well, it snowballs really nicely. And Redbubble has now achieved this critical point. So here's how the website looks and how it works. So let's say I'm looking for something interesting as a gift for a friend of mine. Maybe he's really into, I don't know, Rick and Morty or something. So I'm gonna type in, I don't know, Pickle Rick. There's an episode. Anyway, for those Rick and Morty fans out there, you'll know what I'm talking about. Okay, so maybe I like this little design here with a pickle. And what I do is I click on that style now. And the piece of art can be printed on like a regular t-shirt here. But as you can see, I have other options. I have other different types of t-shirts here that I could put the graphic on. And it also gives me view this design on 71 different products. So I can have a look through here. You can see it can be on a laptop sleeve. It can be on an iPhone case. This is just a framed piece of art. There's lots of different options here. So maybe I think it's going to be awesome to have it, I don't know, these coasters here. Let's say these coasters I like. And what I could do is I could just add this to my cart and then the piece of art would go onto coasters and then get printed out at a manufacturer somewhere near my friend's place and it would get sent to him. And what I can also do is I can just go to Explore Designs and, okay, now obviously, okay, so maybe I like this Warren Buffett portrait here. Being an investor, Warren Buffett's my hero. So maybe one of my other friends who's an investor as well, maybe they'd like this as a gift or maybe I'd like it for myself. So maybe I would, instead of it as a poster or on a t-shirt, maybe I'd like it as in a book. So this is a journal cover and that would be the piece of art. So the artist who made this would get a cut of the sale of this product that I'm going to buy. So that's really cool for the artist. Now the idea is that the artist can upload an image, choose the products that they would like their art to be seen on. Then Redbubble sends this order to a print-on-demand service somewhere near to that location, and the product is printed on demand by that third-party manufacturer and then sent to the customer. And the breakdown works a bit like this. The artist gets 20%, the print-on-demand company gets about 50%, and Redbubble gets 30%. So from the artist's point of view, they don't have to have their own store or their own manufacturers or their own fulfillment services. They don't have to make anything or post anything by mail. They get to just make art and receive royalty checks. It is super simple for an artist to now monetize their design. This is the big difference from, say, Etsy and Amazon. See, Etsy, the creator would create the entire product and make the shipment. So there is a lot of time and effort to create the product individually. And with Amazon, they will handle your inventory and the orders, but you don't make one-off items. You might get 1,000 units made in China and sent to Amazon's fulfillment centers. Amazon is more for mass-produced products rather than unique one-of-a-kind products. Now that means Redbubble has no inventory and is also therefore not just a two-sided marketplace, but a three-sided marketplace with artists, customers, and then the print-on-demand manufacturers. Now from the customer's point of view, they get a cool, unique product that would be more expressive than a generic bag or t-shirt. The choices are endless. The customer is essentially the same customer as Etsy though, so there is some overlap. Now from the manufacturer's point of view, well, they get deal flow without having to find customers themselves. From Redbubble's point of view, they want to grow in any of these three areas, and this will create growth across the entire business. They are calling it the three-part flywheel effect. So if Redbubble can invest to grow the amount of artists on the platform, that will lead to more interesting designs, which will please the customers. And if the company decides to invest in growing customers, this will attract more artists to Redbubble as there is money to be made. Plus, more manufacturers will want to be part of Redbubble's network because there is money being made. Then maybe Redbubble decides to invest in more high quality manufacturers joining the network. This will improve the customer experience, attracting more customers and therefore more artists. So this business model actually feeds on itself as each area grows the other areas. This is really important as the moat around the business will get wider and wider. Now, the other cool thing from Redbubble's point of view, like Etsy, is that the money is paid first, then handed out to the artists and manufacturers. So if Redbubble receives $100, they pay the artist $20 at the end of the month, and then the manufacturer is $50 at the end of the month, and they keep $30 for themselves. This model is far better than retail businesses that must buy inventory first and then sell it to make the profit. Redbubble gets the money first, then pays it out later. It makes the business less risky because it doesn't have inventory and therefore is asset light. Now you might be wondering where I learned all this from, and it's actually from a write-up from one investor I have started to follow. His name's Andrew Rosenblum from Bonsai Partners. He's a very smart guy and has invested heavily into Redbubble himself, and I learn a lot from reading his thesis. Now the business is seasonal like normal retail, with Christmas being a big time of the year. And the core geographies that Redbubble operates in is actually not just Australia. That makes up less than 5% of the market for Redbubble. Now I pulled this website data from SimilarWeb and found that traffic sources are actually mostly from Northern America and Europe. So the total addressable market is huge. Not only is e-commerce already $700 billion globally, it is expected to be more than $1 trillion by 2024. Both Redbubble and Etsy report about 30 to 40% of this e-commerce market are looking for unique, meaningful items. And this segment is also expected to grow faster than overall e-commerce as unique, meaningful products are becoming more mainstream. Simply put, there are a lot of tailwinds for both Redbubble and Etsy. But let's focus only on Redbubble today, as I have investigated Etsy in the past. So far I can answer these questions about Redbubble. I think the business is simple to understand. There's no major gurus have invested, but Andrew Rosenblum at Bonsai Partners is a big investor, and that helps give me a little more conviction. I like the industry a lot. E-commerce, I am confident will grow. Regarding growth plans, well, Redbubble can invest into any of the three areas of the flywheel. This makes things simple to understand and also measure the performance over the next few years. Redbubble is planning to invest in the customer experience to try to improve repeat purchases, plus add more product lines and print-on-demand manufacturers. Better quality manufacturers, remember, attract more customers. And this is how we're going to measure the performance over the next few years. See, we can follow artist revenue, marketplace revenue, gross profit margins, marketing spend, operating expenses, and EBITDA. So this slide here is actually going to be really helpful to keep for each annual report to see if the thesis stays on track. Then I look at the current market cap, which will depend when you are watching this video. Currently for me, it's about 950 million Australian dollars, about 750 million US dollars. So it's still a small cap stock with plenty of room to grow. And that total addressable market is massive. This has ticked all my boxes for the industry section of my analysis. Now I've spoken about the competition already. Etsy and Amazon are the big forces here. Now, I think it is more Etsy that is the major competitor than Amazon, mostly because the target customer is the same. Etsy shouldn't be taken lightly. They are a fantastic cash-producing business that could potentially invest in areas to compete more specifically with Redbubble. So what competitive advantage does Redbubble actually have? Well, they definitely have a network effect advantage protecting them from smaller startups. As that flywheel turns, the competitive advantage gets stronger and stronger. See, network effect businesses are harder to disrupt because getting new customers, artists, and manufacturers becomes cheaper as that network grows. But I haven't addressed what is stopping Etsy from offering print-on-demand services for the artists on Etsy. Well, I think this is probably the biggest risk factor, as I have no idea what Etsy is going to do. But my understanding of Etsy is they are going for more homemade, handcrafted items. Etsy is more about picking up a unique, say, mortar and pestle set, handcrafted by a sculptor. Redbubble is more about the art than the physical product itself. What I mean is I could buy a white mug on Amazon for cheap. Or I can buy an environmentally friendly clay mug set in an open fire from Etsy. Or I could go to Redbubble and buy this T-Rex print onto a normal mug. So it's all a little different. I don't think Etsy will jump into this world anytime soon, as they have their own niche to focus on and grow throughout the world. But I can see why a lot of people might have reservations about the threat of Etsy to Redbubble. Now, something Redbubble has better than Etsy is the artists on Etsy have to do far more work than on Redbubble. Etsy sellers make the product, deal with the fulfillment, returns, complaints, all that stuff. See, artists on Redbubble just submit the art and that's it. It's a far more enjoyable and simple business for artists on Redbubble. So that should encourage artists to stay on Redbubble unless Etsy offers the same deal in the future. But even then, why not be on both places at the same time if it's that easy? Now, copyright issues might be something that will need to be addressed by the company. There are clearly copyright infringements by the artists all over the place. The Rick and Morty example for one. This will need to be sorted out as the business grows. Another area of concern for me is repeat customers. Now, I'm not sure what will draw customers back to Redbubble in the future, but it has been happening, with repeat purchase customers growing at 36% per annum. That is a very good sign and something I think might be tough to keep going. I mean, Amazon has Amazon Prime and so many items that people purchase regularly. Customers are always going back to Amazon to take advantage of the free shipping and the prices. But Etsy and Redbubble are more unique items that are not going to be purchased every month. So I think keeping that repeat customer segment growing will be a tricky area to improve. But they have been growing it, so maybe I shouldn't be so negative, but I just can't help it. My brain thinks this will be a challenge. I checked the Net Promoter Score for Redbubble and it is 80, and that is very high. The Net Promoter Score measures the customer's loyalty to the company. How highly would they recommend the company to a friend? 100 is the best, negative 100 is the worst, so 80, that's really high. Now looking at the financials, we will find that the company has just inflected into profitability. 2020 was a boom year for Redbubble, as e-commerce businesses saw serious increases in usage. It is safe to assume that these growth rates won't be maintainable as the pandemic becomes less and less of an issue for retail. So net income has turned positive, revenue is averaging 43% per annum growth over the past 3 years, but again, we have to be careful of the year 2020 being an abnormality. Free cash flow has been growing impressively. This is great to see. Gross margins are now at 60%, which shows the competitive advantage is getting stronger. So on one hand, the network effect business is strengthening the competitive advantage. Metrics look good, and the Net Promoter Score is fantastic. But on the other hand, Etsy and Amazon might make moves against them. That makes me question what the business will look like in 10 years' time. I think the business will be much bigger, but by how much bigger depends on what happens in the marketplace. If they can get a few more years of expanding that competitive moat, well, it will be in great shape. And when I get to the valuation section, I'm going to want a better than normal margin of safety. Return on equity and return on invested capital are great growth metrics to see how the management team are growing the business through their investment ideas. So over 15% is good. So for return on equity and return on invested capital to both now be above 30%, the inflection point has happened for this business and it's starting to make really good returns. Current debt levels are manageable, mostly because of that cash flow cycle I mentioned earlier. See, money comes in, they use this, then money goes out to the artists and manufacturers at the end of the month. It's like a float in insurance and makes the business very stable. Long-term debt levels, by the way, are practically zero, so there are no issues here. They also don't pay a dividend, which makes sense as they should be trying to grow and invest in that flywheel to strengthen that competitive advantage. A lot of people would think this is counterintuitive that I am happy about no dividend. But I would be very concerned if they were paying a dividend. That would be a red flag for me, but they aren't, so that's good. The next thing I want to see is how aligned is the management team with the shareholders. Now, the founder and director of the company, Martin Hosking, holds about 16% of the company. That is great. He has retired now as CEO, and the new CEO, Mike Izhnevsky, I don't know how to say that name, has only just started, and the board made him buy about $2 million of shares. Some of it with his own money and the rest is a loan from the business. The purpose was to align the CEO with the shareholders. Look, I'm okay with all this. Now, as you can see, there's been a sharp decline in the share price since the peak in January. Now, my thoughts on why this might be happening are that the growth numbers just can't keep up with last year. The world will open up, leading to less online spending compared to 2020. Sure, that is going to happen, but online shopping isn't going away. If anything, I believe people have become more comfortable with online shopping. E-commerce, in my opinion, is a good place to be long term. I also think many investors simply are just not sure how to value the company. It is this small cap Australian company which is far away from the US stock market that has millions more investors. The last point I want to make about management is that shares are being diluted through incentives. So looking at per share growth metrics is important. I don't like share dilution, but it is normal for a fast growing company to incentivize management. I'll have to be careful to look at per share growth metrics to decide on a growth rate. So to get a guide on the growth numbers for the next few years, we are going to use these growth plans set out by the company. Now, revenue, they're going to aim to grow at 20 to 30% per year. They also aim to increase marketing spend as they reinvest into the flywheel. But in 4 years' time, margins hopefully will be about the same as they are, if not slightly higher. Now, with those compounding metrics of return on equity and return on invested capital higher than 30%, we could probably see free cash flow growing at maybe anywhere from 20% to 35%, even 40%, depending on execution. So I'm going to use 20% as that is the low end of this range. And I'm also using 20% because predicting the future is really hard and I prefer to be conservative. Okay, so I have a growth rate worked out now, and I'm going to use a range of methods to work out a good price to pay. Firstly, I'm going to use Phil Town's 10 cap method. This is how you would look at real estate or something like that. It's a way to get a rough value without factoring in growth. So the 10 cap method works like this. You get the owner's earnings or the free cash flow and divide it by the market cap. So that comes in at about 8%. 10% or greater is a good deal. If we instead use enterprise value, which I think is better than market cap as it factors in the cash in the bank and the debt, well, we get closer to 10% at about 9.6. So with this 10 cap method, we are looking like it might be close to a good deal. But let's now factor in that growth. This is a quick valuation metric I have made myself. It's called price to free cash flow to growth. And the price to free cash flow is just a number that is easy to find and often reported, but it just doesn't factor in growth rates. I have made this table to find a range that shows a good price. So since I think the growth rate will be about 20%, well, a good price to free cash flow will be under 25. Right now, the price to free cash flow is just 12. With $77 million as the free cash flow. But even if we adjust this lower to allow for, say, a bad 2021, because for some reason free cash flow levels just can't keep up with 2020, well, using, say, $50 million as free cash flow, the price to free cash flow is closer to 20. With 20% growth rates being conservative, between that 12 and 20 is solid, and since it is definitely under 25, things are looking good so far. If you want a copy of this discounted cash flow calculator, it's free and it's in the description. It factors in a lot more information to get a better buy price. So the first thing I do is I enter the growth rates, and then I make it a little bit less from years 6 to 10. I lower it just to be safe as the future gets harder to predict the further away we are. I then use a big return on investment goal of 30%. That means that if these numbers are accurate, then I can expect 30% return over the next 10 years. That would be pretty great. 30% is very high. So this gives us a decent margin of safety. If we were only wanting, say, 26% or even just 20% per annum returns, if we aim at 30%, well, that's a pretty good goal. Now, the multiple I could sell it for refers to the price to free cash flow after 10 years. Comparing it to Etsy, which is about 50 at the moment, I think a solidly growing e-commerce company easily can get 20 times the free cash flow. Now, operating cash flow minus maintenance capex is a fancy way to work out owner's earnings. The free cash flow number is good enough, so let's go with that. Often maintenance capex is actually really hard to find. This is a bit advanced and honestly not a big deal. Just use free cash flow to be safe. Shares outstanding is how many shares are out there in the world. So if you bought all of them, you would own 100% of the company. And then total cash and total debt are just numbers from the balance sheet. These are extras that help us get an even better fair value. Sometimes companies have huge cash piles, and this makes them more valuable than a company with lots of debt. Now, my calculator does its thing and it spits out a buy price of 3.66 Australian dollars. This would be a fantastic starting price to buy as we get a big margin of safety with that conservative growth rate. 30% return sounds pretty great, and even if it doesn't go to plan, we're probably going to get 20%. Now, what I've done here is I've used a lower free cash flow number as the company might go backwards a little in 2021. It's possible, so I want to allow for that. Now we have a buy price of $2.54. So I got a great price of $3.66 and then an even better buy price at $2.54. That's the range I'd be buying. At $2.54, that's a steal, but I'm pretty happy with anything less than $3.66. Okay, the negatives to this investment idea are: 1. Big players might enter the space and compete more aggressively in the print-on-demand style business model, Etsy being the obvious one. Number 2, copyright issues need to be addressed. Number 3, working out how to continue growing repeat customers is a challenge in my opinion. And 4, well, shares have been diluted, so per share metrics are what we need to look at. But the positives are many. There are big industry tailwinds helping the business grow. The 3-piece flywheel network effect business is one of the best business models. It's asset-light business with no long-term debt. They have great compounding metrics. The founder is still part of the management team. They have a high net promoter score. They have a massive total addressable market. They have an easy path to reinvestment and growth. They're still a small business with a long way to go. Bonsai partners have heavily invested, giving me even more conviction. The network effect model is strengthening the competitive advantage every day, and most importantly, it is cheap. As I'm writing this, the stock price is in my range. So do I think Redbubble is a good company to invest in? So what do you think? Do you like this company? Sure, there are a few concerns about competition, but there are not many bargains out there, and this one, it's a bargain. Plus, I think it is a great business. Now, for more information and discussion around Redbubble, Investing with Frank has a YouTube channel where he discusses it in more detail. There's some great analysis work done by Frank over there. I'll be following Redbubble along from now on as well, so make sure to subscribe so you don't miss my future updates. Hit the like button if you got something out of this, and I will see you in the next video.